Hi, I'm James Robinson, and this is my stock thought of the week. This is my 6th video on my series about value investing theory and fundamentals. The foundation for understanding a company is the ability to review and understand the company's financial statements. So this is the second part of my series, and this is the section that has to do with cash flow statements. As I've said in all of these videos, the language of business is math, and so you have to have a basic understanding of math, but only, frankly, a very basic understanding of math. You also have to have a little bit of understanding of accounting and financial statements and why businesses report the way they do. And once you understand those things, then you can really start to learn an awful lot about a company pretty quickly. And that's the goal of these videos, is to just give you enough information to hopefully whet your appetite to get you more information, and also to help you figure out what I'm looking at as I'm looking at companies, to give you some confidence that I am doing what I think is intelligent research into companies. Again, to reiterate and make very, very clear, this is not a, accounting is a very complex profession, and I don't claim to be an accountant. I'm not a CPA, I'm not an accounting professor. I'm giving you a layman's understanding. So if a freshman level college class is a 100 level class, consider this a college 50 class. I've taken accounting classes and I know a little bit, maybe enough to get in trouble, enough that if you told me I was wrong, I would probably agree, because I don't think I'm an expert. But it's just meant to be a primer, a basic understanding. Maybe it'll give you enough information to make you recognize what's going on. And again, if you have more curiosity, to do your own research. In terms of what are financial statements, I've talked about this on all of the videos that I'm doing on these financial statements. Financial statements are systematized documents that typically are required by the federal government, the SEC, for a company to report to their shareholders what is going on with the company. They're also tools used by management to measure productivity and profitability, and they're a way to figure out the risks and value of the company for investors. While there are an awful lot of financial statements, and while they can get ever more complex and ever more detailed, the standard 3 documents are the income statement. I've already done a video on that. The balance sheet, I've done a video on that. And this final video, which is on cash flow statements. So what exactly is a cash flow statement? Well, a cash flow statement is a financial statement that provides aggregate data regarding all cash inflows a company receives from its ongoing operations and external investment sources. So effectively, it's a way to look at the actual money that comes into a company over a period of time. It works much like a profit and loss, in that it is not measured on a balance sheet, is measuring what happens at one instant in time. A cash flow statement, like an income statement, measures what happens over some period of time. It could be a day, although that's unlikely. It's more likely to be a month or a quarter or a year. The second component is it also measures all cash outflows that pay for business activities and investment activities during a given period of time. So the income statement, we cut through a lot of the accounting and we just simply say what money came in and what money went out, where did it come in from, where did it go out to, and it gives you a sense for what's going on. So more importantly, what you have to understand about a cash flow statement, and the reason there are cash flow statements, and the reason that I look at cash flow statements, accounting is complex, and believe it or not, it's not all black and white. There are the decisions to be made, and there are some things that are open to interpretation, right? But a cash flow statement cuts through all that. There's no real decisions to be made. Money comes in or it doesn't, and if it does, we know how much. Money goes out or it doesn't, and if it does, we know how much, and we know that the relationship between those two either represents a profit or a loss. If you think about it, there are accounting scandals because companies can cook the books. They can make decisions that will, in the short term, for example, make the company look more profitable than it is, or make the company look like it has less debt than it does. I mean, Enron is a great example of this. The auditors looked at those accounting statements and said they were legitimate. Maybe they were, but maybe there's a tremendous amount of great decisions that were all made in the company's favor. But if you had looked at a cash flow statement for Enron, it would have been black and white. There are also accounting items that are almost theoretical, or that make sense in the aggregate, but they belie what's actually happening. So in other words, these issues are accurate to the mind of an accountant, but perhaps not to the mind of a bookkeeper. Again, a bookkeeper wants to know, do I have enough money to make payroll this week or not? An accountant might say, well, we sold $10 million worth of widgets last month, so that goes in the sales category. And then they might say, well, we're on a 60-day payment period, so we're not going to get paid for that sale for 60 days. So in the meantime, they booked that they have a profit or that they have sales now, even though the money hasn't come in for 60 days. And the bookkeeper then looks and goes, I don't care what you sold, there's no money to pay the bills. And that's why there's a difference between the way the bookkeeper looks at things oftentimes and the way an accountant does. And that's why statements can sometimes get crazy. And that's why you like to have a cash flow statement, because it cuts through all that. Other things, there are a number of things that a company can call expenses. For example, they're not really expenses. Depreciation is one. A company doesn't actually write checks for depreciation, but they get to call it an expense. Goodwill is another thing, which is sort of this, it's an accounting gimmick. It has a place. I'm not saying it's inappropriate. I'm just saying it warps what's really happening with the company. So a cash flow statement lets you go through that. And so what it does is it just gives you, as an investor, a different perspective on what's happening in the company. A company can have completely accurate, honest, and ethical accountants, and they will give you one impression as to what's happening in the business. But a cash flow statement might alter your opinion in terms of especially what's happening in the company in the short run. I hope that makes sense. I know it's a little confusing, but just understand there's two different ways of looking at the same problem. They're both accurate. They're just accurate for different reasons, and they give you different information. Finally, one of the things that is most important about a cash flow statement, especially to the investor, is it really does give you a tool to evaluate the short-term viability or sustainability of a company. Again, with the example that I used earlier, where a company makes a sale but doesn't collect the money for 60 days, in the short term, that would create a real problem with cash flow, right, for the company, with income, with the ability to pay its bills for the company, because they've recorded these sales as revenue, but it's not cash in the bank yet. And if that happens on a larger scale, it can really cause a short-term cash flow or cash crunch for the company. But if you look at the cash flow statement, you would recognize that this is what's happening, and determine as an investor whether or not you think this is a risk you're willing to take, and whether the company has whether the company's long-term prospects are matched with its short-term viability. Cash flow, the cash flow statement is really looking at three different categories of cash flow, if you will. One is cash flow resulting from operating activities. One is cash flow resulting from investing activities. And the final is cash flow resulting from financing activities. So we're going to go over just real briefly what each of those three categories are. Cash flow related to operations. So this is anything, any operational activities, including production, sales, and delivery of the company's products. Collecting payments from customers would be income that shows up on a cash flow statement. It includes purchasing of raw materials, which would be an outflow, a cash outflow. It includes building inventory, advertising, and shipping products, etc. It would include payments to employees. It would include interest payments made on loans. And I want to touch on that, or income from loans made. I want to touch on that because normally you would think that interest payments on loans was a financing activity. These loans typically are loans that are related to the operation of the business. That's why the loans are deemed to have been made. And so it's considered part of operations. We're going to talk, when we get to the financing section, about how financing is different than maybe what your initial impression might be. But for now, just understand that if a company's paying interest, those interest payments are showing up in cash flow related to operations. And frankly, you have to be an accountant to really care for our purposes, okay? Cash flow related to investments is pretty straightforward. If you buy an asset, then that would mean you have less cash. So there's a cash outflow to purchase the asset. If you sell an asset, then you're going to be getting money as a result of the sale of the asset. That would be a cash inflow. So hopefully that makes sense. If you make a loan to a supplier, then you would have a cash outflow as that loan is, money is leaving your account to go to the suppliers. And any payments related to mergers and acquisitions. So if you were to buy one of your suppliers, or you were to buy one of your competitors, you'd have less money in the bank because you just bought that person, and therefore that would show up under the investments because you're investing in growing the business by buying or merging with somebody. So finally, cash flow related to financing. This is, again, financing from the standpoint of the business, not financing from the standpoint of you and I might think of, which is financing is borrowing money. It's more broad than simply borrowing money. So if the company pays dividends, that is not clearly operations and it's not investment, it's a financing activity. Sale or repurchase of the company's stock, again, it's not operations and it's not investing, so it's a financing operation. Net borrowings would show up here. Also, repayment of debt principal, including capital leases. So the interest goes under operations, but the repayment of the borrowing of money or the repayment of debt goes into financing. So hopefully that all makes sense. So that's a really quick and brief overview of what's happening with financial statements. I hesitate to say this, but I consider it to be the least important of the three financial statements. I don't spend a tremendous amount of time looking at this, but I do look at information that's derived from this. So for example, when I look at how much companies paying dividends, that data is on the cash flow statement. When I'm looking at the company's buying back of shares or selling of shares, I'm getting that data from the cash flow statement. So it is an important tool. It is something to understand. It's one of the quivers in your arrow as you're analyzing stocks. And don't spend a lot of time on it, but it should give you a sense of where I'm getting the data that I'm using as I'm creating the various slides and as I'm analyzing the various companies that I look at. So that does it for financial statements. I know it's not the most exciting thing, but what I'm going to be doing next is creating videos where we talk about how I use the data that I glean from these financial statements and how I use them to figure out what a company might be worth, how I use them to figure out what might be happening with the company, and more importantly, I use it to figure out if the company is investable. Is this a long-term, solid company that I want to buy? And I do that by looking at all of these charts and all this data over a very long period of time. And so the next one I'm going to do is gross margins, and I think you'll be surprised at the amount of data that you can glean simply by looking at a company's gross margins. So thank you very much for watching. As always, if you like the videos, I'd appreciate it. If you were to comment, that would be great. If you were to subscribe, that would be even better. And if you do comment, let me know, where you live. I'd like to know what city and country you're from, just so I can keep track and put dots on my map. Thanks for your time, and have a great weekend.